Hey everybody, thank you so much for joining us today. My name is Mitch Ferraro. I'm the Investor Relationship Manager here at F Street. Super excited to have you guys with us today. We're going to be talking about the private debt fund. First thing I just want to say is whoever's on right now, whoever sees this recording, super proud of you guys. A lot of people that we see today, they do not do their own due diligence. They do not look at their investments. They do not understand their investments. So whoever's out there looking at this, watching this, I give kudos to you because better understanding your investments is going to help you be a better investor. So big kudos to you guys. Just a little bit about me before we get started. Again, my name is Mitch Ferraro. I'm the Investor Relationship Manager here at F Street. I work with all of our investors that come into any of our funds here. I've been involved in real estate since about 2014. I started investing in real estate, flipping homes. I flipped about 100 homes. I've built my entire rental portfolio through the BRRRR strategy, which some of our investors do that strategy within our private debt fund, the people that we borrow to. And I've been investing in real estate since then. It's a great vehicle. So super excited to get talking about the private debt fund. If just a high level overview of what the debt fund is, if you're looking for passive income, this is the type of fund. This is what we call mailbox money, right? This is money that comes in every single month on the last business day of each month. Great investment to be passive. So what is the private debt fund, right? So let's kind of see. It's a high yield fund. 10% annual interest. We pay it out every single month on the last business day of each month. We hold the investment just for 1 year. After that 1 year, you decide if you want to keep that money in the fund and continue to earn the 10% annual interest, or you can pull your money out of the fund at any point in time after that 1 year. What's really nice about the investment is that, like I was mentioning before, it's extremely passive. You invest your money, and every month you receive a return on that, and that's that 10% annual interest. It's really nice too because for that 1 year, the flexibility of having it pretty liquid is really nice. If after that 1 year you want your principal back, you can get it back. If you just want to continue to have money in the fund and continue to earn that interest, it can do that as well. One really nice feature that we just started as well this past year is you can compound the interest inside of the fund versus receiving the interest every month. So if you want your money to compound and grow faster, you can go ahead and have that money compound every single month instead of receiving that interest distribution. Now, on the front end of that fund, we loan money out to real estate investors that are either flipping homes and they're going ahead and buying a property, fixing it up, and then going ahead and selling it on the open market right away, or they're using what's called the BRRRR strategy, the buy, rehab, rent, and refinance, where they buy a property, they fix it up, they then go ahead and rent it out, and then they go ahead and refinance with longer term debt to pay off our short-term loan. And from there, they then have a property that produces cash flow. Now, what's really nice about this is that every single property that we loan out on, we become the first lien position holder on that asset. We go ahead and make sure that if a borrower is not producing on that loan, meaning they're not paying us their monthly interest payments or they're not communicating with us anymore, we do have the right to foreclose on that asset and take that asset over. It's just protection. It's a piece of security for your investment to make sure that if a borrower doesn't do a good job of borrowing that money, we do have the right to take over that asset. Now, foreclosing on an asset, a lot of people may think, oh, I'm scared, or that's something that that might be bad. It's not. We do a really good job of managing all the assets that are inside of our loan portfolio. If we do have to foreclose on an asset, which we do, we're in the lending business, that happens. We foreclose on about 2 to 3% of our loan portfolio per year. We do a really good job of making sure if we have to foreclose on it, that we go through the process of foreclosure, and then we have some options of what we can do. We can either go ahead and sell that asset on the open market right away on the MLS. We can sell it to an investor within our network that we know that does flipping in that area or does the BRRRR strategy in that area. Or if we have the resources in that area, we'll fix the property up ourselves and go ahead and actually fix the property up and then resell it once we fix it up. But being in that first lien position is very, very important because it allows us to manage the asset and the borrower to make sure that the borrower is successful. Now, we're not in this business to go ahead and foreclose on a bunch of properties. We want our borrowers to be successful. I've seen our owner and founder, Scott Lurie. He all the time does a really good job of making sure our borrowers that might be in a tight situation, get them across the finish line. And that's huge because you know that he's active in the business and he's making sure the borrowers are successful. If everyone's successful, if our borrowers are successful, we're going to be successful. So one other point, we do loan out to 65% of the after repair value. We loan up to that amount. That does not mean our investors are going to get all of that money. That means that we're going to loan up to that amount. And what's really cool too, we do a really, really good job of managing the money. Once we do loan it out, we do give them money to start the project when they buy it. And then we do a draw schedule every single time that they go ahead and request draw. We make sure that the work has been completed. And then once the work is completed, we do go ahead and draw that money to them so that they can actually pay their contractors. So it's not like at closing, they're getting all of this money at one time. We're also managing that as well. So how does this really work? Like if you wanted to get into the fund, you're like, Mitch, I love it. I want to get into it. What does it really look like? It's pretty simple. $100,000 investment into the private debt fund basically gives you a return of $833.33 every single month. Another simple example, $120,000 investment into the fund is $1,000 interest payment every single month on the last business day of every single month. It is like clockwork. Scott's done an amazing job of paying out his investors every single month for the past 15 years. This fund started in 2009. He's never missed an interest payment. It's just a really, really great tool to have some passive income. And again, you can go ahead and not only get your interest payment every month, you could go ahead and actually have that compound every month. We see this as a big benefit for those investors that are using their self-directed IRAs or solo 401ks. If it's in a retirement account and they're not using that money anyways and they're not distributing from their IRA, they just compound it every single month. So it's a great, great feature. We do provide you at the end of the year a 1099 INT. You are taxed at your normal income level for this investment. And we do give ourselves a 90-day period. So let's say after that 1 year, you want to go ahead and request your money back. We do give ourselves a 90-day period to provide that money back to you. Typically though, if it's a smaller investment, a smaller amount that you're requesting back, it's typically within 2 to 3 business days, 7 business days that we can get the initial principal back to you. But what is also really nice is that no matter how long it does take us to get it back to you after your request, you do earn interest up to the day that you receive the funds. So it's not like you make the request and we don't get the money back to you within 15 days that you're kind of losing out on interest. You will earn interest up to that day. So one of the biggest things that I kind of wanted to talk to you about today too is that a lot of investors that are maybe on this call or maybe reviewing this, this private debt fund is a great way to get to know F Street. You start seeing your interest payments right away. You start seeing the investment working for you. We have an amazing investor portal where you'll see your position, you'll see the statements every single month. It's a great way for an investor to almost take a low risk opportunity to see what we do and see how we do this. Now, again, we've been around since 2009 with this private debt fund. Again, as I mentioned before, we've never missed an interest payment. We've never, Scott's never had to call an investor and say, we can't pay you this month. This has been a consistent fund for 15 years. So it's a great way to start seeing how F Street works, see how our technology works with our investor portal, see how we communicate with you, see how I do working with you as your investment manager, trying to make sure that everything that you need is being taken care of. Because what we also like to do is we do new construction multifamily syndication, we do new construction industrial syndication, we do value add multifamily syndication, and those types of deals are a little more complex than our private debt fund. And what's really cool is that investors will start to see us with our private debt fund and they'll start to understand how we work, and then they'll start learning more about our equity deals. And with our equity deals, Scott loves calling them the money trees, and they truly are. They're investments that are longer term investments, they're higher return investments, and they're ways to build generational wealth. So what's really cool is that we want to help you find that perfect mix. What's your risk profile look like? Are you comfortable with us? Because at the end of the day, to me, it comes down to two things. One is your education on your investment, and two, the people that you're working with, do you trust them? Are they the right people that you want to be investing your money with? And do they do the right things to make sure that you are making a good investment? So we want to make sure that we can have a good mix for you to make sure that you can invest maybe in the private debt fund. And then also, we want to build a long-term relationship with you so you can start investing in our equity deals as well. For us, at the end of the day, I don't want you to call me up and say, Mitch, I want to get invested in the private debt fund, and then that's the last time I hear from you. I want to build and cultivate a relationship with you so that I can help you be a better investor, and that allows us to then talk to you about our equity deals as well. So not only do we want you in the private debt fund, but we want long-term investment from you. What's really cool right now, we've got about $150,000 left to raise in our Brown Deer project. Just had a meeting with all of our investor relations individuals. We're really close to closing out that raise. We'd love for, if anyone's on this call right now that is thinking about investing in Brown Deer or wants to learn more about Brown Deer, there is some urgency here. I'm expecting that we're going to be closing out the raise by tomorrow. So if you are interested in Brown Deer and you've either worked with us and you've seen how we work so far, or if you're just interested in learning more about Brown Deer, I highly suggest contacting me after this call to basically give you more information. You'll also be working with some of our development associates on that as well, as they take care of a lot of the equity side of the business. But we'd love to have you part of the private debt fund. We'd love to have you a part of our equity deals. We just love to have you a part of F Street in general. So with that, we wanted to keep this short and sweet and give you just a high-level overview and what's going on and what we're doing. We'll take any questions right now. So please put in the chat if you have any questions at all. And if not, my guys here are going to give you some questions that maybe we can kind of answer. Yeah, so the question was, do we sell off any of the loans in our loan portfolio? And it's no. So we'll watch those all the way through. Basically, once those loans are completed, so essentially completed means someone sold their property on the open market, or they refinanced out of their property, out of our loan to a longer term debt, like a 30-year mortgage or a commercial loan, because they refinanced the property to hang on to it as a rental property. So short answer, no, we don't sell off the loans. So the question was, are there any personal guarantees for the actual investment? So we do have personal guarantees from the borrower that's borrowing the money. So we loan out only to people that have LLCs or an S corp, or they have some sort of entity. We don't make personal loans. But when we do loan out to someone that has an LLC or an S corp, they are making personal guarantees on that loan as well. So do we make a personal guarantee to the investors? We personal guarantee. I'm not really sure. Does that mean like? Okay. Yeah. So sorry. The question was, do we give any personal guarantee? We do on the actual investment. We do provide a promissory note that shows the terms of us paying out the investment every single month, and then we do have a war chest on our balance sheet of about $11 million of Scott's equity in the business. So he holds equity on the balance sheets for any type of if for one day. For 1 month, let's say we weren't a profitable business, which has never happened. That money is on the balance sheet to make sure that the company continues to be able to do day-to-day operations that Scott would use to run the business if we had to go through that. So We do provide the promissory note that allows you to see that we are going to pay you every single month. And then there is $11 million on the balance sheet of Scott's equity that would allow us to basically use that money to keep the operation of the business going if something were to happen. Yeah, so are there any other parties in the fund besides the investors? That's a great question. There is a large creditor inside of the fund. It's about a $50 million creditor. They're the main creditor, CIT. So there is the creditor, and then there's all the other investors inside the fund. That's a really good question. So another good question. So crazy world we obviously live in right now, right? Fed is dropping rates. Interest rates were high. Now they're bringing them down. Will that affect the 10% annual interest that's paid out to the investors? We've never gone ahead and changed that 10% annual interest. We are always charging the borrowers 15% and 5 points to borrow that money short term. And then you as the investor inside of that fund are receiving a 10% annual return. So basically F Street's keeping the spread of the 5% and the 5 points. And that actually term is started out at 6 months. We do allow the borrowers to extend to 12 and 18 months. We do charge them another 5-point origination fee if they have to extend. But that allows us to pay the 10% annual interest out every single month. So I often get the question like, so you guys are keeping the spread of the 5% and the 5 points? Yes, we are. That allows us to be profitable. That allows us to continue to pay you your 10% annual interest every single month. Another great question. So, do we use the fund for any of our other projects? Do we use it for those equity deals? The answer is no. We do not commingle any of the funds. Every single, so all the equity deals and the private debt fund, they're all their own special purpose entities, SPE. So the debt fund is strictly meant for loaning money out through the hard money co to investors. And then every other equity deal is its own SPE. So our Brown Deer project that we have $150,000 left to raise on, it's its own SPE. We have another project, our Oak Creek project, OCLVMF2, its own special purpose entity. We never commingle any of those funds. And when you invest in one fund, that's the exact fund that you're investing in and nothing else. Yes, absolutely. So that's what's really nice about our investor portal. All communication happens through there. You'll also get emails from us. You'll get updates from us. But yes, our investor portal is a really, really good spot where all of our communication is held. Yeah. So for the actual assets that are inside the portfolio, if you ever wanted questions or want to know, what are the assets inside the portfolio, right? About 95% of those assets are single family homes. About the other 5% is somewhere between 1 and 4 families. We have a couple of commercial properties sprinkled throughout that loan portfolio. We have about 500 active loans in the marketplace right now. But average loan size is about $175,000. But if you ever wanted to know, like, hey, what are the exact assets? What are the addresses? We absolutely are. We are as transparent as possible. So we actually could definitely provide that information if you needed it. Yeah, so then the next question was about auditing, right? This is another very good question. How healthy is the business? So every single year we do independent audited financials. We have a third party come in and do financials on the business. We provide those financials if an investor wants them. We do ask that you sign an NDA if you want to see those audited financials, but it is something that we can provide for you so you can see the health of the actual business. This is such a good question. Okay, so as rates drop, what does demand look like for our product, right? Why are investors going to continue to come to us if we're 15% and 5 points and rates continue to drop at a normal interest rate for a mortgage at below 6 or 5.5? Such a great question. So it's interesting. When we go ahead and borrow out that money, people are doing two things. They're either flipping the home or they're going ahead and using the BRRRR strategy. As they're flipping the home, as we see those interest rates come down, that means that there's a lot of buyers out in the marketplace, okay? That means that our investors are still gonna be coming to us to find deals so that they can flip those homes for buyers to buy properties. Another part about that is that if you are using the BRRRR strategy, if you are gonna go ahead and buy a property and you need the money to buy the property and fix it up, as the interest rates come down, you're gonna be able to refinance at a better rate so you can have a better cash flow at the end of the month when you refinance the property out as the BRRRR strategy. Now people will say, Mitch, even though you're at 15% and 5 points, why doesn't someone just go get a traditional mortgage on the house and use that traditional mortgage to buy it and then figure out how to fix it up? Two main points to that. One, a lot of the assets that we're borrowing out on are distressed properties. They are properties that a normal lender is not going to loan out on. The reason why they're not going to loan out on it because the properties that our borrowers are borrowing from, they have foundation issues or electrical issues or plumbing issues or all of them. And everything needs to be updated. There's a hole in the roof. Windows are missing. A normal traditional lender is not going to borrow out on that. So that's where we solve that problem, where we will borrow out on it because we're not borrowing specifically on the asset of what it's worth right now or what it is. It's what can it be once you put the investments into the house. The other thing that a traditional lender will not do, they will not give you the funds to fix the property up. That's where we come in as well. We're not only gonna help you buy the house, we're gonna provide those funds so that you can fix the property up as well, so that then you can sell it at a higher price once you fix it up, or you get it refinanced out to keep it as a rental property. So that was a very long-winded answer on that one, so I hope that helped answer that question, but that's why people won't go to a traditional lender, because a lot of traditional lenders won't loan out on these types of properties. Yeah. So great question. Do we foresee changing our rates from 5 and 15 or from 15% and 5 points? We do not foresee changing those. Quick caveat to that is, when interest rates were at 2%, we were still charging 15% and 5 points to borrow our money. We are a short-term solution for someone to buy a deal, fix it up, and then make a profit, or then refinance out to create cash flow through a rental property. This is not a long-term loan. Now, yes, sometimes our loans go to 12 or 18 months, but the goal is not to stay in this loan for a long time. It's to act quick, be able to fix a property up, resell it, or refinance it out. Okay, all right, so just by the way, these questions are absolutely amazing. I love it. It's about the hold period. We hold the investment for 1 year. After that 1 year, you can pull your principal, any of those funds out of the debt fund. If you decide after, let's say, 3 months of making your investment, you're like, wow, I love this, I wanna add more money into the debt fund, you absolutely can add more money, and that new amount that you just put in creates a new 1 year note for that new money. The old money that was first originally invested still keeps the same 1 year term on it. So you'd have one that's, let's say today you invested 100,000, 1 year from now, you go ahead and you can pull it out after 1 year. If you then 3 months from now, go ahead and invest more money, you're then going to be able to pull it out a year and 3 months from now because you invested it 3 months in the future from now. So hopefully that helped clear up the hold period. Yeah, so where do we lend, and do we worry about judicial versus non-judicial states for foreclosure? So we lend, basically the bulk of the loan portfolio is in the Midwest. I would say about 50% of the loan portfolio is in Wisconsin. The other 50% is in Illinois, Indiana, Ohio, Michigan, Minnesota. all throughout the Midwest. We do have some other one-offs that are maybe are in Missouri, Florida, Tennessee, but those are just one-offs. The bulk is in the Midwest. The Midwest is really our bread and butter. When it comes to non-judicial and judicial states, obviously there's different parameters if you go through foreclosures in each of those two states. We have a whole REO team that takes care of our foreclosures. So we are very good at understanding the process of judicial and non-judicial states. Timing is different almost in every state on when a person can make a payment that restarts the foreclosure process. I will say this, a lot of times when we go through foreclosure, it's not like what you're thinking of a typical foreclosure on an asset when someone actually owns the home that they live in. When someone owns a home that they live in and they're going through foreclosure, they're gonna do everything that they can to possibly hang on to that home. In an instance like this, a lot of times, if we have to go through foreclosure, our investor may have been like, you know what, I can't make the payments anymore. It's your guys' home, take it over. It's a lot different versus an investor being foreclosed on versus a person that's living inside that home being foreclosed on. So yes, we understand judicial versus non-judicial, and we've got a whole REO department that takes care of our foreclosures. So the credit scores we do, I'd have to look to see what the actual credit score would be for. I think we do like a soft pull of. Okay, so we don't pull hard credit. 620 is our low that we go to. We do soft pulls, right? Is that what? And then with bank statements. And the other question was about the foreclosures.
What percentage of portfolios?
Yeah, the percentage of the portfolio, like I was saying, about 2 to 3% of our loan portfolio per year is what we'll foreclose on. Yeah. So what is the size of the actual fund is about $100 million fund right now. Again, about 500 active loans out in the marketplace. I'm sorry, Peter. What was the last part of the question?
What is the minimum investment?
Yep. And the other question was the minimum investment. The minimum investment inside the private debt fund is $50,000. Man, these are absolutely great questions, you guys. Like, I just love it. I love all the due diligence everyone is doing because, again, it helps educate you and gives you an opportunity to possibly invest with us. The question was about how can you invest? You basically can invest a lot of different ways. You can invest as an individual. You can invest through a self-directed IRA. You can invest through a solo 401k. You can invest through an LLC. You can invest through a trust. Almost any entity you can invest through with us. We do get some times where people are trying to understand, how do I roll over like a traditional IRA or 401k because I want to self-direct some of my investments. We do have connections and contacts with trusted self-directed IRA custodians that we can put you in contact with if you want to roll over some traditional IRA money so that you can invest with us. Okay, yeah, so this is a very good question. So what specific documents do I get so that I know that my investment is secured? So we do provide a promissory note that shows the amount that you've invested and that we're gonna pay 10% annual interest through a year period. You do sign a subscription agreement that talks about all of the that you're an accredited investor, just basically, again, that we're gonna be paying you for a year. And then just the question did come in as that secures my investment. So in the fund, you are in an unsecured position. We have to make sure that this is clear. So even though you're in an unsecured position, this is not a bad thing. We as F Street are going in first lien position on the asset. We are in the secured position as a first lien holder. You as the investor come in as an unsecured position, and your investment is being spread across every loan inside the loan portfolio. So there's basically two ways funds can be ran like this. One is that our way that we do it is an unsecured position. When you put your money into the fund, you're going ahead and being spread across every loan inside the loan portfolio. Another way is a secured position. If you were in a secured position, you'd be tied to a specific deal or a specific asset within the fund. That's not how we run the fund. One of the reasons why we don't run the fund that way is that if at some point in time, if your asset was the one that had to go into foreclosure, then you would be in jeopardy of not receiving your monthly interest payment. This way, in the unsecured position, we manage the entire loan portfolio. We absorb the foreclosures. So no matter what, if 2% or 3% of our loan portfolio goes into foreclosure, that's not affecting any investor to pay them their 10% annual interest. All right, I did want to keep this to 30 minutes. We are at 10:30. I just really want to say thank you to everyone that came to this and is asking questions. You're asking great questions. We'll answer a couple more. Stick around if you want to hear the answers to those questions, but I just really appreciate everyone's time. And if you want to invest with us, you can get in contact with me at mitch@fstreet.com or at 414-485-0306. That's my direct line. Thank you guys so much. This has been awesome. So we want another question about the states that we lend in. Wisconsin, Illinois, Indiana, Ohio, Michigan, Minnesota, and then we have a couple sprinkled, Missouri, Florida, Tennessee. The goal is to continue to expand. This is why we're continuing to grow this fund. We know that there's great opportunity throughout the country. We can use a lot of the same processes that we use in these other different markets, but the Midwest is really our bread and butter. Yeah, so and just to be clear, we are open to opportunities everywhere throughout the country. We do market in a lot of different states. We know that we can use our process and systems to be in those states, and we're continuing to look to grow. Yep. Someone wanted just to clarify the minimum investment for a first-time investor. It is $50,000 for a minimum investment inside the private debt fund. Another very important thing to all of this, which should have been mentioned probably in the beginning of this video, is that you do need to be an accredited investor to be able to invest with us. We do go through a third party to verify that information, but every investor that comes into our fund must be an accredited investor. And just a quick definition on what an accredited investor is. If you use income to show that you're accredited, if you file taxes solely, you have to make over $200,000 a year or more. If you file taxes jointly with a spouse, you have to make $300,000 a year or more. If the income does not work, you can go by net worth, and your net worth has to be $1 million or more, not including your primary residence. You hit one of those criteria, and you can verify that information. You are an accredited investor, and you can invest with us. Yep, so if you wanted, let's say you did the minimum investment and you wanted to put more money into the fund after that, you can invest $5,000 anytime you want. So it's just a $5,000 minimum to reinvest more money. So just on that question, do we... Yeah, so a 1099 for a self-directed IRA, you will not receive the 1099 because you are shielded from it with being within the self-directed rollover, a retirement account. So no, you will not receive the 1099. Yeah, so great question. How are we able to take in 5 or 15% in 5 points when a lot of people are doing 2 or 12% in 2 points? It's our easeability. It's our system. It's our process. It's how quick we can act. We do a very, very good job of working with our borrowers. If we have a really good deal, we will be able to fund that very, very quickly. We can underwrite in less than 24 hours. Basically, we'd be waiting for the title company. When a title company can show that there's not additional liens on the property, title company says you're clear to close, we can fund that very, very quickly. Yeah, another great point. That's why we've got a great team around us. So people do shop too, right? They're going to shop our 15 and 5. And what happens a lot of times is those investors come back to us. They know that we're very easy to work with. and they do a really good job. And guess what? At the end of the day, we continue to market out to borrowers all over the country to continue to borrow with us. So we do a really good job of bringing in new borrowers and also hanging on to our borrowers that are currently with us. Yeah, so great question about compounding. Yes, every month you're increasing the amount of the investment, so you will continue to see the interest payment. So if I had I'm not even going to get into numbers. Yes, you are going to continue to see your principal increase because you're compounding the interest every single month inside the fund. Yeah, so we loan money out through the company called the Hard Money Co. You can Google the Hard Money Co. I could send you information on it, but the company that's attached to the debt fund is the Hard Money Co. And again, F Street Investments is the first lien position holder for that actual asset. All right, guys, we're gonna stick around just for a couple more minutes. I think we got all the questions answered. If there's any other questions, keep them coming. This has been absolutely amazing. I love the questions. In the hot seat, I love it. I hopefully answered all the questions that I could and gave you guys some better understanding, but stick around for a couple more minutes. We'll do that, and if there's any other questions, let us know. Yeah, so the question was just about the fund itself, the assets and the amount of money that's in the fund. We've got about 500 active loans out in the marketplace. The fund is just about $100 million, and we've got $11 million on the balance sheet as a war chest, as a backup, just in case at some point in time we had to use money to operate the business. There's $11 million on the balance sheet. Okay, so it was a minimum of that we'll loan out on. There's not a minimum that we'll loan out to. Our standard size is about $130,000 for a loan. All right, guys, thank you so much again. Again, my name is Mitch Ferraro. I'm the Investor Relations Manager here at F Street. You can reach me at Mitch, M-I-T-C-H, at fstreet.com. Again, thank you so much for your time today. I really, really appreciate it. We're going to stick around for a couple more minutes, but you'll continue to see stuff like this. And please, we'd love to have you a part of the F Street team.
Excellent.
Okay, so we had a question about do we do blankets, and we are assuming that you're saying like, do we take collateral possibly from another property, or do we look at loans where it's a bunch of different properties and you want to get a loan on all of them? Yes, we will do that. Thanks everybody. Again, Mitch Ferraro from F Street logging off here. Everyone have a great day, and I hope to hear from you soon.